Is the 60/40 portfolio structure dead? How do you design the best portfolio? What is the best way to create the safest portfolio that can still outperform the market? Today, we're going to dig into this and more.
Well, I love this topic. It's so important because we're not really buying, you don't buy individual investments. You build a portfolio. Um, and I love talking about it. And for those who don't know, my name's Dave Levine, successful entrepreneur and investor who's invested through 8 bubbles. I now see bubbles as clearly as you see these. And although I enjoy trying to teach you everything I've learned, I'm not a trained financial advisor. Do your own research. So, yeah, one of the greatest breakthroughs and improvements to my investing came when I finally understood that you're investing, it's a portfolio, and what that really means, you're maximizing for risk management. And what that means is, everything, it's not like, oh, I know this is going to go up or I know that's going to go down. You never know anything. Everything has a chance, and there's a implied reward if that chance plays out, or a cost, how much it'll go down if it doesn't play out. And so with everything, you got to know the bear case and the bull case and the potential upside and the potential downside. And so with that outlook, anything can go in your portfolio if it's correctly sized. I shouldn't say anything. If something has no chance of going up, right? And a little chance of surviving. Okay, obviously that doesn't really have any place. But we talk about, oh my God, that crypto token, it's so risky. I mean, if it works, it would be worth a lot, but it's so risky. Okay, well, it's so risky, it could go up like 1,000%, 2,000%, but it probably won't. Okay, well, what if a 0.5% of your portfolio is in it? So then it makes sense. Now, to make that 50% of your portfolio would be absurd. So when you start thinking about sizing, and so when people say to me, oh, what should I buy now? My first question is always, well, what do you have already, right? And it's like, are you buying ETH now? People ask me, I'm the biggest buyer. Are you buying right now? No, I'm not buying because I already have a gigantic percent of my net worth in ETH. I'm not buying anymore. It's not that I don't believe in it. And even if you thought, oh, it's going to go up tomorrow. Oh, it's definitely going up tomorrow. First of all, nothing's definite, but I already am exposed and it might not go up tomorrow. So, I don't know. That's the high level on it. Do you want to point in the direction here before I continue ranting?
Yeah, definitely. I think that diversification in general is really popular because I think investors feel like if they're have diversified bets across multiple products across multiple sectors, that they'll hit one of them, right? And as long as they're in at least one of them, and so they spread out their bets, right? And so in most of investors' minds, they're saying the more bets, the better chance of hitting something, the more exposure increases success of making money, right? But there's an argument that could just be like a false sense of security, because investing is already challenging. It has so many unknowns, so it's really hard to cover all your bases. And this approach may or may not be flawed because it takes volatility as the main measure of risk. So, for example, if we rewind back to 2018, 2019, whatever, the last bear market, you could have been like, okay, I think ETH is going to do good. All right, I think Neo is going to do good. I think Ripple is going to do good. I think Ethereum Classic's going to do good. You
Are
know,
you just trying to torture me by naming all of these horrible tokens? Where? Stop.
I know, I know you hate hearing that, but I mean, the fact of the matter is that a lot of investors did this. They spread themselves across many different bets instead of taking like a concentrated bet on a high conviction. And you know, say they invested in all those 10 different platforms, right? And they ended up being right on ETH. They were extremely right on ETH, but they didn't size correctly and they were spread so thin that it didn't really matter. It didn't really affect their portfolio the way it actually should have had they took a more concentrated bet approach and had more conviction, and had instead kind of spread themselves too thin. So yeah, can you talk a little bit about that?
Yeah. So, the bigger topic here, and this makes me think, okay, this video could go on for an hour, which is, so, the idea is you're constructing a portfolio, and then there's different types of portfolio themes in the portfolio on how you're trying to construct it. And, one of them, you mentioned at the beginning of the video, which I want to talk about too, 60/40. But diversified portfolio, like the goal, like you explained it, I think, okay, right? It's just, you're diversified. So if one thing's going down, another might be going up, or at least not everything's going to go down at once. And, a lot of people have heard this argument. First of all, just to back myself up here, I mean, Warren Buffett, I think it was in the last meeting specifically, the last, Berkshire Hathaway meeting. And you can probably find a clip on YouTube. And I think he's been saying it for years, diversification. And I might be quoting him when I say, I think he said diversification is stupid. I mean, literally, he's just like, it's ridiculous. Like, what? Because the idea, and this is something that I've come across as well, which is, it's like the key to investing that he says, and I agree, is to find the thing that you really know what the hell's going on. You have a knowledge advantage. And this is very hard. And when you're young, like, you don't know your knowledge advantage feeling until you get there. And I think when you're young, the idea that you know something that like nobody else knows, and by nobody else, at least 80%, right? Because it's the market's not balanced, pricing it in. Peter Thiel talks about this. He's like, you have to know a secret, right? It's not a secret on how Ethereum works, but the idea that Ethereum is harder money than Bitcoin, you could call it a secret. People don't talk, nobody's talking about it. I mean, not nobody if you're in the thing, but it's
Right.
not widely accepted. So anyways, the idea is you have this knowledge advantage, and then, you put more money in that. And I mean, I recently had this for myself. Now, one argument for diversification is like, well, I don't really know. I don't have a knowledge advantage, so I should just spread my bet. And this kind of, for me, I want to have a bet in genomics with stocks, right? And I know nothing about I know enough to know that it looks like it's a good growth area. And I do like being in different areas. I think that makes sense. I don't want to be all in crypto, things that will move at different times and in different scenarios. So I want to be in genomics a little bit. So I buy the ARK ETF for genomics, and it's diversified. So, the first thing is, if you want, okay, there's another point here, is being realistic about what your expectations are. What I always tell people is, for half of my investment money, I'm in crypto, and my expectation is, if I'm going to get rich, it's going to be in my crypto. Big bet on Ethereum. These are things that can go up a ton. I really know, I feel I have a knowledge advantage in the things that I invested. With my stocks or my home, I'm not going to get rich. My house may appreciate, my stocks may go up, and I did get lucky. I almost consider it lucky that I made so much money in Tesla. My objective there is to just keep all my money. So, and the difference being with this biotechnology front. Now, if I had a knowledge advantage in genomics and really knew the industry, and I picked the one genomics company and put a lot into it, and I'm right, I'm certainly going to make more money than holding this fund. but I don't have that option. So that is a diversification. And, and I like also, I own some gold because there are some scenarios. Well, first of all, I do feel like gold could do well over the next 5 to 10 years. But also, there is a part of me that's like, yeah, there could be a scenario where everything's sort of getting killed and gold does well. I don't even know that that'll happen. But then, so gold's killing it. So now I could sell some of that gold to buy the other stuff cheap. So there are some advantages to being aware of diversification and taking advantage, being somewhat diversified. However, the number one goal needs to be, and then we'll get to my favorite portfolio construction is a one called the barbell construction. So I think we should talk about 60-40 and then also the venture capital model. Talked about just buy a bunch of shit and one goes up 10, one goes up a ton and makes the whole portfolio. Venture capital versus what I feel I'm doing is called liquid venture. So I mean, these were a lot of things here to go.
Yeah, so let's just kind of run through them quickly. We won't rush through them, but we won't spend a ton of time on it, but we'll outline the important parts. So let's go through the 60-40 first. Can you explain what that is?
So 60-40 is the idea, and I think I got it right, that you would have 60% of your portfolio as stocks, 40% bonds, or maybe that's when you're younger, and then when you're older, it's 60% bonds and 40% stocks. And the idea is that bonds are less volatile and have a constant income stream. And when stocks are doing poorly, people run to bonds. So your bonds do better, or maybe and interest rates go down. And the idea is it's a bit of a diversified. When one does well, the other one isn't as much, and you've got the half of the safety. And so it worked really well for decades. One of the reasons was, let us not forget, we had a 40-year bond bubble, which every once in a while, and like something seems extremely obvious, which is the bond bubble popped, which means we're not going back to 1%. Like we're not going back to 2%. The bond bubble popped. You can have years. It's such a long, slow thing. You can have rallies within whatever, but it's like, so it's easy when you're 40 or 60% is in a 40-year bull market, to outperform. And then stocks, sort of throughout history, private corporations have been a good return on investment. So that has worked. Now we have a problem because bonds are now in a bear market, which might last decades. Again, you can have years where they do better than something, but stocks, there's all kinds of problems in the fiat world. And again, it's not, I don't love just stocks and the ETF. The S&P 500. I know it's done well throughout history, and I own Berkshire Hathaway instead of S&P 500. But to me, the two were very similar in that probably does well. It makes its 8% or something over the long term. But so much of like S&P 500 is just the big 7 tech AI related stocks, and the government's trying to steal money wherever they can, and they're coming. So I think that just that and that diversified portfolio with those categories, without talking about, I'm going to have a knowledge advantage, we're just going to have 60% and 40% of a bunch of stuff. I just think that's certainly is going to outperform me, and probably in competition with many other methods, I think would underperform. And I think the barbell one, my favorite, which we'll talk about.
So we'll just recap that. So the 60-40, like at this point, it might still be a good strategy. At the same time, it might be a bit outdated as well. Like,
I just think it's got a lot of headwinds. You got bonds are very difficult, and you got a big percent in bonds. And the stock market, at best does its long-term average, but it also has a lot of headwinds in this environment, at least, and it's over the short term, over 10 years, you might make it back, but at least, yeah, I just think it has a lot of headwinds, and it's not focusing on all having also a bigger portfolio that would include your crypto or venture, and I'm crypto and venture, I may lump together, and real estate. The world is the world of investments is a lot bigger than stocks and bonds too. So
Right.
I just think it's, outdated and a lot of headwinds.
Okay. Yeah, I agree. Let's move to Barbell. I find that one interesting too. Can you explain why that's one of your favorites?
So the I sort of stumbled upon it. I was doing it, and then I found out there's a word for it. So on one hand, I find myself in this world where I have great conviction on something like Ethereum, which, you know, whether you agree with me or not, my analysis is if I'm right, I mean, we're talking about trillions. Like, it's huge. It goes up another 10x and another 10x for 20 years. I mean, it's like, if I'm wrong, I mean, we used to say, oh, if we're wrong about crypto, then it goes to zero. Ethereum's not going away. It's not going to zero, but maybe it's dead money. So it's one of these wins you could call a high risk, or, high volatility at least. And I have a lot in that. And you could say Ethereum plus the apps, just the crypto world. On the other hand, I'm retired, from having any income. And I need cash for a while, so I don't have to sell during the boring low or early in the bull. So I got a lot of cash. I own my house, no debt on it, just own the house, right? And then I have some stocks, like with Warren Buffett. I'm just trying to be more conservative. And so it's the idea that instead of the diversified and the 60/40, you've got a bunch of things on one end that, I don't love the term high risk, because it in turn almost like high volatility or high variance in outcome possibilities. And I obviously think the upside is much higher. You've got these high vol possibilities on one side, and a lot of them. And then sort of nothing in the middle. I don't have a lot of like, oh, it's going to do really, like if your ETH is going to do amazing, whereas this stock is going to do probably okay for a long time. I don't have that stuff in the middle. And then all the way on the right side, it's like cash and a paid off house. So I've got, which is extreme low volatility. I know even housing prices are moving these days, and maybe you can say cash is becoming volatile. But the idea is that on the other end, you're trying to limit downside, don't worry about upside, focus on safety. And that sort of construction allows you to be in both worlds. So, and then the adjustment is, like right now, my safe pile and my cash pile is at a minimum, because I think we're but the next, the next cycle is we have the boom, right? We have the boom, the bust, we're in this boring low that goes on for however long. Then we go up. So I'm tilted. Now, when in 2021, we're all crazy and everything's really high, I was pulling out of that high end and throwing it into the safe and building up the safe part. That's when I bought my house. That's when I, was accumulating tons of stable coins or dollars. And that's when I bought I sold whatever I was I don't know specifically ETH, but I was pulling out cash from crypto to buy Berkshire Hathaway and, put it in there. But now so anyways, and that's the idea. And none of this in the middle diversified 60/40,
Right.
owning, a
Right.
high yielding bond, would be the typical example of in the middle. Who needs it? You get risk for what? So
Yeah. Yeah, no, I like that one a lot. And if I was older and I wasn't such a degenerate, I would have that exact portfolio as well. But what I really like about that is that on one side you have all your safe stuff, but on the other side, on the side where you consider it, high volatility, risk on, it's still in like a relatively like safe blue chip asset, like ETH, right? Like yes, you are exposed, you have tons of volatility, but at the same time, like, it's a $250 billion asset, right? Like you said, it's not going to zero tomorrow. And at the same time, there's still tons of upside. So that's why I really like the barbell with ETH on the risk on side, because yes, it is risk on. There's tons of volatility, but at the same time, it's the safest bet you can make in crypto.
That's why I don't like the word risk, because it implies like there's a high chance it could not do well, because in our mind there's not. But that's why I like high volatility, hold,
Yeah.
because oh yeah, it's going to do great, and then it could fall 50% tomorrow. So, and one thing I would say about your, with the age and the barbell, now if it's today and somebody has no safe stuff, I would still be tilting toward the riskier. You're young, or if you have income, and it's like fine. But when you have that boom, it just makes a hell of a lot of sense before it falls by 70% to accumulate some of that stuff that you'll hold forever, like the house you live in, or some stocks and whatever, and it's in your IRA or whatever, to accumulate that stuff. Because I know, and I'm better I navigate, I see bubbles as clear as you see, but especially when you're younger and you don't see the bubbles so clearly. So many times, I had a few times in my past where, it was everything was great. And I was like, you know what, I'm just going to pay off a little bit of my mortgage. And then for whatever reason, everything goes to hell. And I feel like the only thing I have left is that the lower mortgage. Like, it just couldn't believe how it went away. And so it's a good discipline when things are big to put stuff in that, and that's a good way to visualize that safe stuff, is like, it's not going to go away. Like, like I said, a house, and even cash in the bank. We have inflation. I mean, listen, if it starts getting Zimbabwe-ish, okay. Yeah. But, if inflation is 10%, you lost 10%, but it's not 90%, right? That's what we're dealing with crypto. So
Yeah.
And if it's in a year when crypto goes down by 9%, you're happy to lose 10.
Right. Yeah. And look, when I say degenerate, I mean, I don't own a house, but I'm 95% ETH. The other 5% I have spread across like Uniswap and Aave and just, other applications built on ETH. But like, I don't think I'm that much of a degenerate, having so much in ETH. It's just that I don't have much safe stuff because, unlike yourself, I still have income, right? I still have a full-time job, and I still have, more earning years ahead of me being younger. So yeah, I really like the barbell. That's one that I see myself in definitely the nearish future, and once I get that house and those safe assets. And that one's always been super interesting to me, especially having ETH on the risk on side, because it's such a perfect asset.
I literally spend time thinking, okay, when ETH crosses 10,000, am I going to fly to Miami and start looking for houses? I'm worried about California, but I mean, to have down the street something on the beach, like, what am I going to do when ETH crosses 10,000? Granted, because once it crosses 10, you've got like 8 months to buy a house, right? And this is why everybody, I'm going to tick and sell the top. And what are you going to put it into? And are you really going to do that? No, we'll be dollar cost averaging. And I bet it, and accumulate in cash, get enough, you buy a house, whatever. Okay.
Yeah. All right. So let's move on to liquid venture. Can you explain that one?
Right. Venture capital, for those who don't know, means, first of all, it's early stage investing. They call it like Series A, Series B. What that means is, a company starts, they have a seed investor, they get a little momentum, you get there, it's Series A, they get an investment, then there's these stages that are traditionally like, the ball, they get to a certain point, and then they raise Series B, C, D, I don't know how many letters they go through, and then there's the IPO on the stock market. This is the traditional path, and venture capitalists, because of the way it works, they put their money in the Series A or Series B, and they don't get it out unless there's an IPO in the stock market. And an IPO in the stock market means it's survived all that time, it's gotten big enough, and then IPO gets higher multiples, and that's a big cash out. So if you invest in a Series A and 5 to 7 years later at IPOs, you made a ton of money, right? And these are in tech stocks that can grow a ton. So there's this huge upside potential. But if they don't make it, there's no liquidity. You can't get out and it goes to zero. So the model has been that people say, and a lot of venture capitalists can't even do this, which is invest in 10 and one of them hits and makes it all worthwhile. In crypto, one thing a lot of investors don't understand is that these investments are like Series A, Series B investing, which is a lot harder than buying a public stock that's been out for 10 years or even IPO'd. Those are very established. Those are, maybe if ETH was a stock, it could IPO, I don't know if they would in this market, but they're like almost IPO size, right? And that's why also I say, it's not going to go to zero. But all these other things, as much as I love whatever, Uniswap and I don't know, I don't even see Uniswap disappearing, but okay, there's a whole, what's the token worth, blah, blah. But a lot of FXS, Frax, I do love it. I root for it, but it's just like so many things could go wrong where it literally goes to zero eventually. Like those are venture bets. But in crypto, what is great is, as opposed to the way I explained the traditional venture, the other important part about actual traditional venture capital, how do you invest? You actually have to know somebody who allows you in the gate. And then, your investment, I mean, if it's 100,000, it's tiny. I mean, you're doing hundreds of thousands, if not million. If they're the big ones that they all know is going to make it, it's like $1 million to the starting one. But if you want to do Series B type investing in Aave, I don't know, you put in $10. You can start, you can get in dollar cost average, or you have a bull case, or Uniswap. One thing I love about it is I can go and see their trade volume in real time. I love this one chart I look at. It shows Uniswap and all the decentralized exchanges and their trade volume in real time, updated. You can go there every week, and you could make a little investment because Uniswap has the biggest market share. And you know what? Every week that they continue to have market share, I'm going to buy another $100 of it, And then you start seeing, the market share is going down. And most people don't look at fundamentals, meaning Uniswap is a trading. So guess what? The more people and dollars that are trading, the better the investment is. And you can watch that. People don't watch that. They look at charts, draw lines on charts, and look for like tweets of that, all kinds of stupid things. Or they don't even pay attention because they think it's traditional venture capital and they're just waiting for 5 years with their eyes closed. Anyways, if you see the numbers ticking down, you can start selling $100 a week of it and get out. And I have had this with some of these early things. There are things I love. Remember Ren? I loved it. Thing was booming. And then I was just like, wait, what? First of all, I didn't like they pivoted. I didn't like where they pivoted. I didn't think things were working. They weren't growing. And I'm like, you know what? Screw this. I'm getting out. And, but way before everybody else got out, and in fact, I remember talking to somebody who's a smart guy, wealthy, and this is back in when I think it was actually the December of 2018 when Bitcoin was around 3,000. And I'm just like and he's worried about me, friend, family, actually. And he's just like, you're betting on this Bitcoin. He's like, what if you're wrong? I'm like, well, if I'm wrong, I'll see it and I'll be out before everybody else sees it because I'm so on top of it. Okay. So anyways, in January of 2020, I decided I'm wrong. Again, I don't hate Bitcoin, but it's like I'm wrong. I don't think it's going to be the digital gold. I think it's so I got out. It went to Ethereum, and I think in 5 years people may figure it out. Talk about being early, assuming I'm right. I've been quite early on that move. So anyways, so that's the difference, is that you don't need to know anybody to get in. You can get in at any size. There's liquidity the whole time. And that's why also I don't do the pre-sales. These pre-sale token things, that's like seed investing. That's like, or you're trying to play the old insider game. Oh, I'm an insider, so I'm gonna fuck retail. When like, I don't believe in any of that shit. And I mean, sometimes it does work, but it's just, yeah, I don't play that game. And you also can adjust based on news. And the other advantage is, with the crazy volatility, even if, whatever, Uniswap's numbers are awesome and they're awesome, but I'm like, well, we're definitely at a bubble. So I don't want so much in this thing. You can also take some out or put some in based on the giant swings of the market. Again, never do day trading. I'm talking about over 5 years. Like, for the past year has been a good time to get in to anything in crypto that you like, and in 2021 for the whole year was a good time to get out of anything. And so on those big swings, so you have that liquidity. And so I just think this is better than venture capital. Venture capital has had decent returns for those who are good, but I just think this is such an amazing way of investing. And I just have been doing, I thought I was the only one. And then there's a guy I follow, Arthur, you know what? I'll put his thing in the description below. And he has a fund even, and I don't know about his fund. I don't know that he's the greatest. He's a smart guy. I follow him on Twitter, but he's like, it's called Liquid Venture. There's been articles on it. There's a few people who focus on liquid venture, public tokens, but they understand it's early investing and they're doing it sort of the way I'm doing it. And one final note, I know I'm going on forever here, but I spent a lot of time thinking in 2018, should I start a fund? And I came for a number of reasons, and this might not be true for everybody, but I was like, I think I can make a lot more money by spending all my time being a good investor than I can be probably spending all of my time dealing with the mechanics of a fund, convincing a bunch of idiots to give me money when they don't want to because it's down, and then convincing them that I'm not an idiot for selling and not wanting their money when it's up high, and I'm just like, it's better. So liquid venture from your home, and you don't have to go to San Francisco, to fight the homeless and hobnob with wealthy people and put up $1 million.
Yeah, definitely. I think you're talking about Arthur from Defiance.
Yes.
Yeah, I definitely familiar with what you're talking about there. And in regards to the ETH BTC trade, I think that's like another example of like kind of being early to something where like 85% of people like would not agree with that, and like that's not consensus. But I remember in January 2020, I think it was actually a little bit earlier than that, maybe like December 2019 or something. I kind of had that same kind of thought and thesis, and I was just doing so much digging into Ethereum. I was just so deep into the community that like I just had zero interest in Bitcoin, and I just did not resonate with what they were doing or what they were saying or anything. So I had traded my last and final Bitcoin into ETH, I think at the end of that year. And then you had made a video, and we weren't in touch then, but I was an avid follower of you. But you had made that video, and I'm like, wow, okay, like, all right, Dave's doing it too. I feel like I'm in good company here. Like, I feel like I'm probably on the right track. And like, I think at that point, my final Bitcoin got me like 48 ETH or something like that. And if you look at like how much ETH you get today for like one Bitcoin, it's like 14 or 15. Like, and I expect that to just like keep going down. And that's just like in regards to ETH BTC. I feel like that just like each year is going to generally just decline over time. Like, yes, there's times where Bitcoin will kind of have some more dominance, and that will go down a little bit. But long term, I think like I completely agree with you. ETH BTC is going up and to the right. But yeah, I thought this was like an important topic because the general idea of diversification is to dampen volatility. But like I was thinking that like dampening volatility might possibly introduce like more risk into your portfolio. Like diversification usually protects against ignorance and people that like are not paying attention. And that might be like for you if you're just like not wanting to do any research and not follow along and just like not look at it for 10 years and see what you got. But like if you're paying attention, like even a little bit, it might not be, the best strategy. And like I've always been in the camp of just like put a lot of your eggs into a basket and really watch that basket. Like really, really, really watch that basket. And if there's a time comes where you start to kind of get a thesis against that basket, then make a decision from there and move it. But like I feel like I feel like a lot of investors really want to make the most off of their opportunity, right?
And
And I
then
feel
a
like
couple, can I interrupt? Because I feel like I'm going to forget, and this is so important. And also people watching this who aren't, yes, the best way to make money is by making that big bet. But let me just say, first of all, you better have a knowledge advantage. It's not like, oh, I'm going to roll the dice and go big on this.
right.
The other thing is, if you are making a big bet on something, because it's a great idea. Like, well, what you said, if you hear something negative about it, you should know all the negatives already. You should know that, like, the bear case better than the bears know it. And there are two sides. If you don't think there's a bear case, it's just you haven't done your research. And finally, if you are making this big bet on something and everybody else wants to do it and is telling you you're smart, it's probably also just bad timing. You're like, you're caught up in the mob, which it doesn't mean you're stupid. It's just like it happens, right? Like if you were like, I'm going all in on Ethereum in 2021, you could have easily been in a crowd where everyone was like, yeah, dude, yeah, whereas now if you say it, what's the reaction going to be? Negative. So in other words, it's one of you can get I don't know if the right term here, false positive, which is, yes, how you want to invest is know something really well. And Warren Buffett talks about this a lot. Know something really well and bet big. And like you said, watch it. But it's not the betting big that's the good part, or is that the important part is that you actually know something that nobody knows, and you really know, and you bet big. It's like if playing poker, you don't win by betting big. You win because you have whatever so many aces, and you know enough about what everybody else has, and then you go all in. That's a good investment, right? It's not like, oh, I'm just gonna fucking bluff. So
Yeah.
sorry for interrupting, but I get it.
No, I think that's actually a really good point that I wasn't really making clear. Like it's not just like, oh, don't diversify and just concentrate your bets. No, concentrate your bets in something that you have high conviction on and you feel like you have some alpha and knowledge that most people are contrarian to, or it's just not the consensus. It's not just, hey, I'm just gonna YOLO and make a big bet into something because Dave and Kevin said that's the right thing and not to diversify. It's like, no, make sure that you are very confident in the research that you've done and the bet that you're making. And that's how I felt about Ethereum in 2018 to 2020, where I was comfortable just making a heavily concentrated bet into that. It didn't make sense to buy other tokens at that time because ETH was so incredibly undervalued, mispriced, and misunderstood. So yeah, I think that was a really important point to make that I wasn't making clear. So thank you for that.
One other point to remember is also with all this stuff, as we talk about it and people think about it, they're like, it's all sounds like numbers. You're looking at the trade volume, for the Uniswap. You're looking at, the numbers and the number of wallet, it's a very quantitative thing we think of when analyzing the value of a company or stock or bond, whatever. What's the economy doing? The part you also have to remember is the psychology. Talking about that trading in big, I'm guessing you're not that social like me. Are you a bit of a hermit? Because I just remember at the time in 2020, it was like, and I went to a conference and it was like everybody was bowing down because Bitcoin had outperformed, never, I mean, since for so many years. And then in the bear market of 2018, Bitcoin beat everything. And then at the beginning of the bull, Bitcoin totally everybody was like, if you sneezed that Bitcoin wasn't the best in the world and everything else sucked and Bitcoin would beat everything, everyone would just call you a moron. Like, it was psychologically difficult. And the market timings and buying stuff early and making it, like, anyways, a part of it is if you're not having trouble psychological, and by psychological, I don't mean like that you can't sleep. It's just when you're around friends. One thing I like to say, when do you know is a good time to sell is when all your friends are telling you you're a genius. Like, I mean, if you're like me, you know you're not a genius. So when they're telling you something's wrong, right? So
yeah, no, yeah, you're right. I am naturally an introvert. I mean, I love my alone time. I'm still social, but at the same time, like, I love my alone time. And during that time, I was just so deep into it. And I don't talk about my investments much, but some of my, best friends they know I'm an investor, and they'll ask me, and I mentioned something like Ethereum back then, and they would just change the conversation so quickly. I had absolutely zero interest, and I was like, okay, like, I'm probably on the right track here, because they don't even care. Like, not only that they not understand, they don't even care to understand. And that was a sign to me that I was like, I'm in a good spot here. I'm just going to keep my head down. I don't need to talk about this with anyone. And I just became numb to the volatility. There was a lot of time I was underwater on so many buys through 300, 200, whatever. It didn't matter to me. I was desensitized to it. I wasn't thinking I didn't need this money. I wasn't thinking that I needed to sell. But I was thinking that, this is either incredibly mispriced, or I am so dang wrong and, like, out of my tree that, like, it still looked good to me because no one else was talking about it. Like you said, like, I would have felt a bit more uncomfortable if I was making such a big bet on it and all of my friends were doing the same. Yeah, I'm doing the same thing, man. Yeah, we're all doing it. Yeah, to the moon. Like, I wasn't getting that. So yes, it was uncomfortable being underwater, but at the same time, there was no hype. There was no one talking about it. So it felt less risky than it actually was.
And one more point that I just remembered from something earlier you said about, diversification, trying to reduce volatility. It's, one of the issues with all these portfolios, it's not that 60-40 is bad. It's that it's not 1990, right? All you had was stocks and bonds were in the middle of an bull market going to 0%. No one saw that coming. Like, that was the time. It's a different time. And regarding volatility, it'll be awesome to reduce volatility. I think you're swimming upstream right now. Like, okay, God bless if you can reduce volatility. My advice is learn how to surf and ride the waves. Like, I'm not trying to reduce volatility. I'm trying to take advantage of it. When stuff is ridiculously high, you take some off the table. When it's really, you know what? I'm going to roll with the volatility instead of trying to build a dam to flatten those waves. Get out the surfboard and have someone video you. So a lot of this is simply, we're in a new world. Things have changed, and I'm not here to say that the old venture capital model was really bad. It wasn't. It built the tech industry. And again, in the 90s, if you were in venture capital, although a lot of venture capitalists didn't do well. I mean, the numbers you had to be the best. But again, the venture capitalists created the Google and the Amazon and whatever, probably every big tech company. And, now I just think it's a different world, and you got to roll with the world you're in.
Yeah, I think all this stuff is good, and I hope our viewers found this informative and helpful for their current or future investing. So don't forget to like and subscribe. Give us a comment below. Let us know what sort of portfolio structure that you're most interested in, or that you do, and any opinions, thoughts, perspectives on things that we didn't touch on, or things that we did touch on and that you might disagree with.
And I love helping people. Like, it's literally like when I have friends who are like, oh, can you give me some advice on my portfolio? I'm like, you don't understand. This is fun for me. I'm not like, oh, I can't believe you're going out of your way. I'm like, no, this is better than going to the beach. I love the whole process. And people, if you want, you put your portfolio in the comments and I'll give you some feedback. It's interesting to me. I like doing it. And also in the description are links to my other things, Twitter, Discord, whatever. And also, Kevin, we forgot again with your introduction. Nobody has. Kevin is the anonymous guy who appears to own some ETH. No one knows anything. You have no intro. We got to remember. I don't know. Someone commented to me like, "Who is he? Why doesn't he have an intro?" I'm like,
that's true. I was doing a short. I should do a longer intro.
Well,
like a little backstory, maybe one video, give like a couple minute story of.
Well, this is perfect because I'm such a narcissist that I only want to be introduced, and everyone look away. Don't look at Kevin. It's all about me. I mean, listen, I do have a little more experience than him, but appreciate your help. And I mean, the intro was, listen, I talked to him when he called me and said, I want to do the show. I'm like, well, who are you? And I talked to him for like a half hour, just realized, he's a younger guy than me, but he's done well with the ETH and he seems pretty smart and measured. And, I mean, that is his resume, right? You've done a decent job for a young guy. Especially with a crypto focus. So I don't know. And he gets me to make videos. What else do you need?
I've done okay. I'll do maybe next video. I'll spend like 2-3 minutes and just kind of say a little bit more than I hold ETH. So,
and maybe one sentence I throw in the description. Kevin is whatever. Just I don't know.
Yeah. That sounds good.
I mean, I like that you're not just here to pump something. And what's also funny, I've had, I usually can't get anyone who wants to be on a show with me. I don't know why. And there might be something wrong with you because you like this. But I did have one other guy contact me and he's like, I want to do a show with you. I'm like, okay. And then, and then he was sort of nervous about it. And then he never called me back. And like, I literally could never get guests, you're like, I don't know what your problem is. You like
I'll take that as a compliment.
Yeah. No, thank you. And this was a good video.
Yeah. So. Thanks, guys.
All right. At least, and for those, when I say it's a good video, I think these are important concepts. I have things, and sometimes I tweet, and I'm just like, this is so important, and nobody cares, nobody reads it, no one likes it. Okay, whatever. But I'm just trying to do what I think is important. And these are very important topics.
Yeah, I think most people and myself have always found them important, and I think a lot of people would rather listen to a YouTuber saying that a bag's gonna go to $1 million. It's just, we're very grounded. I feel like we stay realistic, we stay with risk management, and I feel like most appreciate and respect that. So we'll keep doing that, and thanks for tuning in, guys. We'll see you next week.
Thank you.